Well, good morning, everyone. This is Harshit Bajpai, and today we're going to discuss the case of long-term financial planning. This is video part 2. Now, as given in the case, we are given assets and liabilities of the balance sheet as well as a P&L account, which says that net income for the last year was this much, and according to dividend and the retained earnings, we can easily calculate that the retention ratio or 63.8% of earnings have been retained. Now, let us look and see first that we have to calculate, as in the case, internal growth rate as well as sustainable growth rate. Now, we know the formula of internal growth rate is ROA into B upon 1 minus ROA into B, and ROA is net income upon total assets. Similarly, it follows also sustainable growth rate, ROA into B upon 1 minus E into B, where ROE is net income upon shareholders' equity. Okay. Now, for the current year, we can calculate that ROA, which is return on assets, is nothing but net income upon the total assets, that is 18,308, which comes out to be around 8.84%. Similarly, return on earnings is net income upon the total owner's equity, which comes out to be 1069. It comes out to be 15.27%. Now, using the formula here, we can calculate ROA and ROB, putting the Excel formulas as here. This is ROA into retention ratio upon 1 minus ROA into retention ratio. It comes up to be 5%. Similarly, putting the formula, we can calculate the sustainable growth rate to be 10.75%. Now, what does this imply? So, what does this imply? If the firm wants to grow just on retained earnings, it can grow on a year-on-year basis at 5.64%. But if the company wants to grow more, it can grow at 10.75% without changing its capital structure. Now the question is, if the company wants to grow more, even more than 10.74%, then what is the next step? It will have to use more and more debt, which will distort its capital structure. Okay, now debt equity ratio, as we can calculate, is total debt upon shareholders equity, which is total debt, sum of these two, divided by total owners equity, and it comes out to be 0.82%, which is quite high. Now, there is one more thing called as asset turnover ratio, which is nothing but total sales upon total assets. It comes out to be 1.66 percent numeric. Now, there is something also called as capital intensity ratio, which is just nothing but inverse of asset turnover ratio. Let me explain what does this mean. Capital intensity ratio means how much of dollar that you need to invest in capital to generate the sales. Here we can see that it is less than 1. It means that it is a relatively less capital intensive business. If this ratio had been, say, 3, now this could have been a very highly capital intensive business, because you need to spend $3 to generate $1 in sales. Anyways, let us continue. Question at hand is the sales. The scenario that is given is the sales is increasing by 12%. Okay, so this is the sales for the last year. This is the sales for this year. Now this they say forecasting increase of 12%, 1.12, which means a 12% increase. Now, accordingly, the cost of goods sold, expenses, depreciation increases, interest remains the same. Therefore, we get a net income of this much. Now, keeping the retention ratio same, we get an addition to retained earnings and the dividends, which is more than the previous year. Okay. But the question is, we have calculated IGR, SGR, no problem. The question has been asked, what is the external financing needed? How much more this company has to invest uh, to grow at 12%? Now let us see. The cash the last year was this much, increased by as a percentage of sales to 493, or a 12% increase. Similar is for account receivable, inventory. So we get a total current assets of this much, and the fixed asset also has to increase to support the growth, and this comes out to be 18 million approximately. So the total assets that we have is 20 million approx. Oh, much more than 18 million last year. Okay, now let us see on the liability side. Last year it was 308 million, 18 million. Now this year, only on the liability side, the account payables and note payables will increase, because the long term debt and equity are basically independent of the amount of sales. It doesn't mean that you sell 2 pence more, so your long-term debt will increase. No, it is irrespective of the sales level. Similar is the common equity. Only thing is retained earnings will increase, because each year, as we have shown you, that there is addition to retained earnings. Therefore, the retained earnings from last year has increased. Okay, now due to this increase in current liability, total current liability comes to be 19.8 million, but the assets at which we need are 20.5 million. Therefore, there is a deficit of $730,000, or let me calculate. This is the assets which you require. This is the liability that which we have. So there is a deficit of $730,000. Now this deficit has to be financed if we want to grow at 12%. Now, so the question is, as we already see here, that internal growth rate is 5.64, the sustainable growth rate is 10.75. Therefore, if you want to grow at 12%, if we want to grow at 12%, we will have to increase the debt in our balance sheet. So let me give you, to finance this deficit of cash. We have two ways. Either we can increase the current liabilities, or we can increase the retained earnings. We can also increase long-term debt, but I will not suggest that because the amount is small, that you increase the long-term debt. So we can increase current liabilities, or we can increase the retained earnings. Let us first see about when we increase the current liabilities. Okay, so in the green column we can see that I have increased the current liabilities by the amount of $730,000. Okay, after increasing it to $730,000, I have my asset become equal to liabilities. My external financing, which now I need, is zero. The consequent changes that we have to see are in the debt equity ratio. The debt equity ratio decreased because of increase in equity, but if we have to grow at 12%, we have to include debt. Therefore, this is the new level of after increasing current liabilities, our the debt equity ratio increases to 0.833, which is an increase over 0.82. Okay, so we have to see, already 0.82 is a significant amount of debt. Okay, so if the company is not comfortable, it has already stretched far from already 0.82 is more, they don't want to increase it to 0.833 level. So there is another alternative, that is increase the retained earnings. Now how can we do that? The next year we according to the traditional policy, we are distributing a dividend of $639,000. Okay, if we do not distribute this dividend and use this piece also to finance our growth, the blue column says I do not increase my current liabilities; they remain the same. Okay, I have increased my retained earnings from approximately $10.8 million to $11.5 million by adding the available uh, dividends. Okay, now so my okay, so after increasing my owner's equity, that is to this level, by adding retained earnings, my total liabilities come out to be $20.4 million, and my assets that I require is $20.5 million, which means a deficit of $90,000. This deficit is substantially lower than $730 million, which we had previously. Okay, now let us see another important aspect. I have not increased my liabilities, but I've increased my I have not increased my debt liabilities, but I've increased my owner's equity. So let us see in the option 2, my debt equity ratio comes out to be 0.726, which is substantially lower than 0.82. As you can see here, this is the new one, this was the earlier one. So from 0.82, this is substantially lower. So it is a better option in case your debt equity levels are too high. So a company has to decide what course of action do they want to pursue. Which are in fact limited by practical considerations. Now let us look at one more practical consideration, which is that as mentioned in the case, that the new plant which we have here, let's see here, it just cannot increase, the fixed asset cannot just increase in terms of the sales. Therefore, according to the another analysis, it has to increase by $5 million minimum. Okay, so now we have the earlier level of assets to be this much, the new level of assets is this much. Accordingly, we can see here that the amount of financing which we need is approximately $3.8 million. A significant amount of financing is needed to expand, uh, which is incredible. Now, in order to really grow over 10%, the company will have to use a host of financings. It will have to increase its retained earnings, increase its current liability, as well as use some long-term debt if at all they want to grow over 10.54 percentages, 10.75% as we see sustainable growth rate. Now, if they increase their capacity by $5 million investing in current assets, what will happen is their capacity utilization will drop from 100 to 0.85 85% capacity. So their capacity will also drop. So that is also a negative advantage. So there are a lot of things to think about. Earlier it was just $730,000. Now it is approximately $4 million. So the company has to look into the how much growth rate they really want to grow at. If it's sometimes it might not be feasible at all. So thank you very much for listening to me and listening very patiently. For any queries, you can email me at harshad.baspe.19 at gmail or comment on my blog. Thank you very much for watching.